Well, I think you take two things out of this. Number one, I think the chairman kind of admitted he was behind the curve, and he came out. And
he didn't say it. He said, no, let others make that judgment.
I said he kind of admitted it. He admitted it by saying 7 this year, 4 in the following years. So he put 11 rate hikes on the table. And to me, that was, without ever saying I'm behind the curve, saying, OK, we've got some work to do ahead of us. But I also think by doing that, he has got the market in a position where he is now, as you said, put him in a position where every meeting is live. But every meeting being live means that he doesn't necessarily have to raise rates at every meeting. But he has prepared the market for a position where he could, if he wants to, raise rates at every meeting going forward.
So you think the next surprise could be actually they don't raise interest rates at every meeting?
Well, I think that's the position he's put us in right now. I think by saying every meeting's live and saying I'm going to raise at every meeting, he's probably put that optionality on the table. That's how I interpret it. I think that's how the markets have interpreted it. And I think they're interpreting it as, okay, he's admitting where we are. He's admitting where in many respects, he's admitting they're behind the curve. He's admitting where inflation is.
But why is that a good thing for the market?
Although the inflation number they put out is not one that I think they can get to.
Right, so they expect 4.1% at the end of this year.
Yeah, I don't think they can get to that in any way, shape, or form.
What would be a more realistic target?
Look, they're going to get help on inflation. They're going to get help on inflation because, as you know, the baseline is going to get better for them. As we get into the second half of this year, we started having a lot of wage and commodity inflation in the second half of last year. So when you look at the year-over-year numbers,
the comps get better.
The comps get dramatically better.
Yeah.
So literally by doing nothing except moving the months forward, our year-over-year inflation numbers are going to start looking better and better, whether he raises rates or not.
But you still think 4.1 is aggressive?
So I think anything with a 4 handle, it's pretty aggressive. I think he'd be lucky to see something with a 5 handle. It's probably somewhere in the high 5s, low 6s is what we're going to get. We still probably haven't seen the peak. You know, a lot of this volatility that's still in the system has not fed completely through. We've still got a lot of input inflation. We're going to see that on the commodity side. Everyone talks about oil. No one talks about the agricultural market. The agricultural market's probably more important
we do now, watching wheat.
Than the oil. It is. It's more important than the oil market. The oil market you can turn on, you can turn off. You get planting seasons in the agricultural markets, and if you miss the planting window, it doesn't reoccur. So the oil market is a little bit different. We're just talking about, can you ship it? Can you ship it out of certain places? Are you displacing oil from one market to another market? And I think we found that that's what's happening. That's why prices sort of resumed back to where it was sort of pre-Ukrainian situation. But the wheat market is completely different. You know, the wheat market, we're going to get one planting season.